It's not the dog you're dog sitting, right?
No. It's not the dog I'm dog sitting, but it's my neighbor's dog downstairs. And
I can hear it. Yeah, that sucks.
So, but it's like all day long. I mean, I just hope to God that Cora is not like that.
She is when we put her in the crate when we're leaving. She's very upset about it.
Yeah, but then one day she'll get crate trained and then she'll be okay with it.
Well, no, and that's what we're doing. We're crate training her. And then the problem is, well, not even the problem is we get home and the issue is like if we don't get to the bedroom fast enough to let them out, she starts to do it again. It's like Cora, calm down. But no, she's beautiful. She's wonderful. She's a classy broad.
Oh, and, really? She's one of those. Okay, so she drinks wine with her pinky up.
Oh yeah, right. No, okay. She
is adorable and gorgeous.
And like I said, as soon as we can, we're going to get her into a...
You got good genes.
I know. Usually they're Levi's, but sometimes American Eagle.
Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, two bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy. And welcome back to yet another presentation of Drunkenomics. This is the drinking podcast, or the drinking presentation, or the drinking podcast, whatever you want to call it, with an economics problem. We have an economics problem, and we like to drink to it. So cheers. Hopefully you have a stiff one in front of you, unless you're about to drive somewhere or do something.
Or are currently driving, who knows?
Yeah, exactly. Either one. Please drink responsibly and
be drunkenomical.
That's it. Right? That's the one. Be drunkenomical. I think that's what we say at the end or the beginning or both of every single episode.
We want you to be that. So be drunkenomical is to drink appropriately and not drink appropriately, right?
Yeah. That's know when to have your Irish coffees and when to not have that.
When it should just be a coffee.
Yeah, I said that weird because it's been 2 shots before the mic is hot. Speaking of 2 shots, I want to give a quick shout out to our Facebook and Twitter and Instagram. I guess Facebook and Instagram are meta now, so those are our 2 shots.
To our
Meta and Instagram.
To our metaverse and our
Twitter
beans.
Whatever it is. At Drunkenomical, That's bad.
Wait, no. DRUNKENOMICAL.
Oh, you almost said it.
I've got it. DRUNKENOMICAL.
DRUNKENOMICAL. Whatever it is.
Did I just get that?
I don't know if either of us got it, but Drunkenomical, I'm sure you can just sound it out and spell it. I feel bad that we just couldn't spell it, but you know what it is, man.
We're on a roll.
I blame the Bushmills. I blame St. Patty's Day because that was last week. And I had a great time.
Absolutely.
And I hope you did too.
It was weird. Lincoln, it rained. So like it shut down at like 11:30. But also weird. I worked and we had comedy night at Cigars Lounge.
Oh, geez.
To be fair, it was actually one of the funnier comedy nights I've been to.
Really? Did Rob do his thing?
Oh, yeah. Rob was doing his thing.
Rob,
what a guy. Rob Davies, if anyone's looking to book a pretty funny guy, very dry, funny. Very dark.
I'll give it to
Rob
him.
Davies out of Lincoln, Nebraska. Check him out. It's very dry. It's very dark. And I'll be honest,
and very funny.
It gets worse.
Well, I think dry. That's my kind of humor is dry, dark humor. Mm-hmm. So, I mean, sorry. Don't hate me. Don't judge me. You're already doing it anyway, so whatever.
Well, there's a reason. There's a reason we're friends.
Yeah, exactly.
The same thing.
There's a reason why all 3 of us are friends. So yeah.
Oh yeah.
Dallas was great. I mean, I don't know. I had a very weird experimental weekend. I don't want to get into it. So let's get into the episode. What should we talk about?
It's been a weird week economically. Can I start with my geopolitical war news out of Ukraine? And I'll say this.
Okay, yeah.
I only want to say this one
Ukraine
thing
because we have to.
And then it's over. And it's just this one off. And it's based on everything I've read, based on all the things, all the information I consume. Russia their campaign has failed. It's stopped. They were now to stalemate. We're about to see. We're going to see
the warfare campaign, that kind of stuff.
Well, yeah. A campaign is a military organizational movement to achieve specific strategic goals, and the Russian strategic goals were clearly probably threefold, and it was to use light and mechanized forces light airborne and mechanized forces to seize Kiev, to seize Mariupol, and then several other major population centers in order to install a puppet government as well as to build a land bridge between mainland Russia and the Crimea that doesn't require the bridge that they built that doesn't actually work for moving the supplies the way they need to move supplies. And that was the major strategic goal of this. And to be fair, they have succeeded in absolutely zero. We've gone to step. Now they're going to be able. Now the Russian army is going to be able to take Mariupol in time. It's a city that's under siege, starving, totally cut off. There's problems. I would call it very mildly as the United States has accused them of today. It's a war crime. You're targeting civilians.
I saw that today.
A city. It's an issue. You can't.
They declared that a war crime.
But that's that. So whatever the Russians are about to do, it turns out they're digging in. They're laying minefields. We're now reaching a stalemate. So we're gonna run into a First World War situation of trenches and
so just kind of like a wall and
a prolonged
no advancement
engagement.
Yeah, so like I'm trying to advance here and you're trying to prevent this advancement. So because of that,
correct.
Like a trench. I don't think it's actually going to be like modern warfare is nothing like trench warfare at all.
Well, historically it hasn't been, but the problem is the Russians don't own the air, and so they can't run the ground because the Ukrainians have all the fun toys from the U.S.
I get it. I totally get it. Yeah, I mean Lockheed Martin and Raytheon. The stocks that you mentioned last week, they're sending them all this kind of stuff. They're buying all this stuff, right? And
other people are buying from the U.S. government is buying from them and then sending it.
That's what I mean.
Yeah.
Okay, so someone's buying it and they're sending it over there. Not financial advice.
Yeah,
but all that's I saw that on the news.
What I'll say is I have one share of the DFEN and I bought it at I want to say 19.
Thanks for your disclosure and congrats on the profit.
I'm not sure it'll stick. And I sit here. I bought it because
we'll see. Because Germany's increasing their military budget like crazy.
We'll see. And so is Italy.
And so is Italy. Yeah. So I mean, a lot of the countries in Europe are doing that.
What bothers me again about that is it's kind of like it's why is 20% is Boeing? Really? Well, it's DFEM, which is an aerospace specific focus.
Yes,
I was like, Boeing has always been the weakest of the shares, which is I expect the reason they're 20% is because Boeing was cheap to buy at the time.
Yeah, well, exactly. And their appreciation kind of led to that 20% concentration. But like, I also think that maybe if your focus is aerospace, like why is it not Lockheed Martin?
Yeah, why is it only 5% Lockheed Martin, which is substantially more? Why are you more on like civilian aerospace than on defensive aerospace? And that's my question.
So
that's why I only bought one. I had the ability to buy separate.
And who knows?
I went, I'll buy one to track.
And let's see. Like maybe next quarter their prospects will look a little different.
Maybe they shake up their
I mean, we have no idea, and none of this is financial advice because I'm hammered right now.
I'm also not sober, and
my bad.
And even let's put it this way. I bought in when I look at a fifth of the thing I'm buying into it. I go, I don't like this.
Totally.
My thing is, I still to be excited. I say, why isn't Raytheon higher?
Well, I guess despite all geopolitical tensions, I mean, last week was a winning week, the first winning week of I forget how long was it. Is it the first winning week year to date?
I think it must be. It must be because
it could have been.
But it might be the first winning.
All the markets are up.
The first winning week, but it's not. Let's say the month of January was down by almost 12% across the board. The month of February was about 3.5%.
I thought they were down 20% after the carnage in February.
I might be only looking at NASDAQ.
Okay, because I thought it was down about 20%. The S&P was down 20% after the carnage in February, March, after the carnage in January, February, and the first week of March. But last week was a winning week. I didn't pay attention to the markets on Friday because I was very hungover from St. Patty's Day. So I don't know what happened on Friday. I have no idea. Friday didn't even exist to me.
I went to work. I think the markets were down. And frankly,
all I know is that I had no.
What I will say is
short options that expired on the money on Friday. That's all I know. It's the only thing I know about Friday.
And in many ways,
which is a good thing for me. I
guess
short some options. None of them were.
Before we jump into the full episode, I think we should talk to Pantson over in our Fill and Kill channel on our Discord. So you heard us initially say. And you get an invite to the Discord just by being there. You
finding us on social media.
And so what I'm going to say is, Benson, I was gonna write to you in the Discord, and I felt like it would seem, I don't know, not harsh.
Well,
but
let's just cut to the chase, man.
like,
the dude bought a Lagavulin 16.
You got a Lagavulin 16, and I'll be honest, that's a delicious bottle of scotch you got right there.
I'm just saying that thing would not last very long around me.
It would
Log
not.
16 has no chance around me.
At a Drunkenomics table between the two of us, it lasts not longer than one night.
Not longer than one presentation.
Absolutely.
Not even close.
Having said that, it is going to be, I'm going to warn you, it's going to be a lot peatier than a lot of the other whiskeys you could possibly run into. That being said, it does have a lot of sweeter notes by value of it being 16 years age.
It's smooth. I don't know. I don't want to say it's sweet, but it's smooth. It's very smooth.
That's
so,
fair. That's fair.
But if you're tempted to get into whiskey, you're diving into the deep end, and man, I applaud you for that Log 16. I will recommend to anybody any day of the week. I love it very much.
Yeah, you're diving into the deep end, but it's the sweet spot. Not
really
flavor wise, but just quality wise.
Quality wise, that is one of the best. And bang for buck, Log 16 is easily one of the best. I would say I guess Bowmore.
The dollars.
I guess Bowmore is
Bowmore 15.
Oh, God. Okay.
Yeah,
why'd you have to bring that up? You're making me have to be a liar.
No, but I'm not, because what I'm saying is the dollar difference between Bowmore 15 and Log 16, fair enough for 1 year. I'd say that dollar difference, it equates to 1 year. It's fine.
I know, but
I'm okay with that.
Bowmore 15 quality wise is also
very high.
I don't know.
It's okay. You come to the right island.
I know, but you're talking way over my head now, dude. This is like talking whiskey is way too complicated. So let's talk about economics.
Aaron, we both
and let's simplify this.
We both know that's not true.
That's definitely not as complicated as
Aaron,
whiskey.
We were going to call this show Whiskynomics initially.
I know. Which Drunkenomics?
It's called Drunkenomics, folks. It's not just enomics.
I know, exactly. As much as we'd like to talk about the enomics part, because it's much easier to talk about than whiskey, because whiskey is really complicated, and the enomics part it really isn't.
Easy peasy.
Wait, did I get the backwards?
Supply demand squeezy.
Supply demand squeezy, man. Equilibrium squeezy, dude.
Oh man,
yeah, I know. But speaking of capital markets, sorry, that's a weird transition.
It's not.
I just want to get back to the.
It's not the weirdest. I mean,
I know, but because I don't know what happened on March 18th, but it seems like March 18th was a pretty bullish day. It was like a bullish but kind of flat day, and then I think a lot of it. I think a lot of it was off the backs of the FOMC meeting on what was that? Was it Wednesday?
Yeah,
day before St. Patty's Day.
Correct. Yeah. Here's my thing: if you're gonna do a meeting the day before St. Patrick's Day and you're gonna half-ass your interest raise, what's the point?
Yeah, nothing got done. No. Literally, nothing got done.
And now they're back to the 2 50-point raises according to most of the street.
So they're saying the target
with 50.
I know, but my thing is the target inflation rate is what 4.3% at the end of the year, which I'm like, dude, that's not gonna happen. That's not gonna happen. I know that's not gonna happen.
They need to come with a hammer.
100% agree with you. Because of that, they're saying, I mean, there's a bunch of polls out there, which, gosh,
I know.
If I had the power to, I would start a sports book on FOMC meetings.
Aren't they saying April and May are going to be 50 basis point meetings each? Isn't that 80% of the street thinks
I'll say this. From what I've seen so far is 72% of the street thinks that there's going to be a 50 basis point rate hike in May. Ugh, Irish whiskey. Is delicious. So
always.
That's what I'm saying.
It's not.
Even when it's not, it's always delicious. But I haven't seen the June one. And I don't know what's going to happen in April, but I don't see us going to 4.3% inflation with these 25 basis point rate hikes. If at the end of the year, our interest rates are 1 3/4 to 2, that's not going to bring inflation down.
Not even fucking close.
There's
the math isn't even simple algebra says it doesn't work.
I know. Even if we bring down our balance sheet from 9 trillion to, I don't know, 200 billion or whatever it normally is at. Even if we did that, I just don't see us bringing inflation down.
It doesn't work.
The math doesn't check out. And not to mention, in case you guys are wondering, reverse, what's that word? Reverse repos.
Reverse repo, yeah.
They're still hitting record highs every week. They're still hitting record. It's still 1.8 trillion now. So another 1.8 trillion in reverse repos, sucking money out of the economy. That happened this week. So even with all that, it's not. I mean, with what? I mean, how much was in QE in 2020 and 2021?
Substantially more than that. Let's put it this way: when they were doing,
totally.
How many billion were they doing a quarter in QE?
In QE or in reverse QE?
No.
Which time frame?
Just in the mortgage space. 90?
No.
Billion a quarter?
No. 90 billion was just in bond purchases. Yeah, so it was 120 billion total. 90 billion was in I think I could be way off on this.
No,
but it was
I thought
90
it was
billion
30. It was 30 billion a quarter in mortgages alone.
Not necessarily mortgages, but MBSs.
Well,
so they're
because it's a bond market, but it is specifically the mortgage bond market.
Yeah,
so
exactly. So they're helping banks finance mortgages.
Yes, if you're wondering why housing prices have shot through the fucking roof, it's because one, there was 0% interest rate, and two, because the Fed was just
financing all these MBSs,
everything.
Yeah, because it's if you're a bank and you're like, okay, I know for a fact $30 billion worth of mortgages are going to be bought by another bank, and then from there it's going to be bought by the Federal Reserve.
I'm going to sell it. I'm going to sell it.
Why would I not write a mortgage? Why would I not? I'd be stupid.
And we're back to the 2008 bullshit of I write a mortgage on Friday, and a big bank has bought it by Monday lunch.
Yes, exactly. And talk about another headline that we saw.
The average house in the United States, what is it, $500,000 now?
Yeah, the average house in the U.S. is now above $500,000. A record 8% of houses in the U.S. are worth over $1 million.
Let me tell you what the average American makes, and it's not enough to afford a $500,000 house.
Yeah, absolutely not. And then not to mention, mortgage demand has plummeted 12% annually, 2% over the course of the week. Refinances, so the demand for people refinancing their house.
Interest rates are going up, so that makes sense.
I mean, that makes sense, right? All that makes sense. And the 30-year mortgage rate has gone up what is it at now? Does that say 4.5%?
Thought it was.
I can't see that graph. Whatever it is. 4.5. 30-year mortgage rates are at 28-month high.
Yeah, 4.5, 4.5.
Yeah,
that's fair.
In my drunken state, I can't really tell.
To be fair, I had to click on the picture.
4.5. 4.5%.
4.5.
All right,
that's pretty substantial.
Well, compared to the last 28 months, of course it is, man.
Fair, that's the fixed rate.
Yeah, so let's not even get into the adjustable rates, because the adjustable rates, I mean, throughout the course of the year, I mean, Godspeed to you all, man. Not that. What the weird thing is, it's like I can't afford a $900 adjustable mortgage, but I can afford to pay rent for $1,500 a month in a one-bedroom apartment, which is kind of weird.
To be fair, I think the U.S. economy. My thing is, reading this, the U.S. economy is substantially better position than China.
No, I totally agree with you.
For those of you that listen, you'll recognize that we discussed Evergrande's. I want to call it a failure. Somehow it's worse than that because people are arresting the fall. They're like, let this thing fall down. I'm not going to let it fall immediately, so I'm going to hold it up, and then the second I let it go, I'm actually not going to let it go. I'm going to push it towards the ground too.
So what exactly happened with the whole Evergrande fallout thing? Or I guess what's happening with it?
So a few things right now. So the first thing is that Evergrande kept trading on the Hong Kong. On the Hong Kong exchange,
because they technically weren't delisted, right?
Because they weren't delisted, they just in a bad place because the company sucks. Why would you buy equity in a company that doesn't have the cash to pay?
It's kind of like Nikola.
It's all bad.
It's kind of like Nikola. Yeah, they're still listed.
Why would you? If you listen to our older episodes, you'll realize why would I want to become an owner when if the company goes bankrupt tomorrow, I am the last person getting paid out on things I paid in for. Why would you do that?
I might sell debt, but I'm not gonna.
Yeah, I might buy bonds because at least in the event of a liquidation of the company, I get paid before the actual owners because I'm a creditor and they're just owners, right? So so what happened is on Monday, Evergrande, their shares were suspended in trading, so they aren't trading right now.
Are they still suspended?
They are still suspended. They are suspended until they make whatever their announcement is, their board announcement. And the announcement, the funny thing is that everyone looking at it is going, it's clearly some sort of bankruptcy announcement or some sort of like, hey, China's giving us $1 billion. Yeah. The government's giving us $1 billion to do it, but it's one of those things where it's gonna rattle the company.
Yeah, well, I mean, Chinese real estate has. I mean, we know
has been
that market has just been terrible. So as much as I'm dogging on American real estate, Chinese real estate is 1,000 times worse.
So much worse.
I don't want any exposure to that. Yeah.
Well, the real problem is on top. Is on top of
PwC.
So PwC is PricewaterhouseCoopers,
which is a giant company here in the U.S. They're big accounting firm.
There's four major accounting firms globally, and it's PricewaterhouseCoopers, Ernst & Young, KPMG. And Deloitte & Touche. Deloitte Touche Ross.
Deloitte,
or just Deloitte, as it's called now.
Yeah.
Those are the 4 big accounting firms globally.
That's just because Deloitte gobbled up all this, but whatever.
Oh, it's Ernst & Young gobbled up Arthur Andersen, which was the biggest in the United States.
They were the big 5, and then
then Arthur Andersen was Enron's guy.
Yeah, they're in bed with Kenny Lay, and then but anyway, so
and it gets worse.
PwC is doing their thing with Evergrande.
Is supposed to be was Evergrande's
they're auditing them.
Their auditor, and so what happened is
let's stop here for a second, because what I want to talk about is if you're hired by a company like Evergrande and Evergrande pays you a ton of money to audit them, and I'm saying that with bunny ears, they obviously want you to give them a sweetheart deal because they're giving you a sweetheart deal by paying you. They're saying, hey, don't fudge up our numbers too much, right? Like, make us look better. Do whatever you can to make us look better and make us look transparent and honest.
When they
paying you millions of dollars.
So when they hire me, they don't pay me millions of dollars. They pay you several thousand.
Okay, well, at
that
scale, maybe they do pay millions. Maybe
you're absolutely right. So when they hire me with the understanding they want is an unqualified opinion,
which is not entirely true because they're paying them a ton of money.
But you should always when you read a balance sheet or an accounting report, realize that the accounting firm giving this opinion has been paid by the person they're opining on.
Yeah.
Now, having said that,
there's rules.
Having said that, there's rules, there's laws, but more importantly, the only value in an accountant's opinion is the fact that he's honest with you. So Arthur Andersen doesn't exist anymore because they said that, for several reasons, but they said Arthur Andersen, Arthur Andersen said, Enron, their books are beautiful. Nothing's wrong here. There are absolutely no problems. Continue to invest your money. Now these guys want to go and they want to give an opinion on the next company, Disney, for instance. So if someone is showing you books and saying, hey, these guys are legit, and if someone says, oh, Disney, from the guys that brought you Enron, and you're not going to trust it.
They say,
you're not going to trust it for an instant.
I wouldn't.
Right?
No.
You wouldn't.
I would trust Bernie Madoff more than that, probably.
Well, I mean, I'll be honest. You're not wrong, but at the same time, at least if you're on the right side of a cash out from Bernie Madoff, the Ponzi scheme was in your favor.
So, I mean, I guess
that's how Ponzi schemes work. So,
right, But the thing is, and there's a bunch of rules about accounting firms because, like, if you're affiliated with a company whatsoever, like if you have an uncle that works there or a cousin or a third cousin that works at a company, you cannot be a part of that audit team, even if you're the most qualified accountant.
You can't be the audit partner.
I was told by people that work at accounting firms that you can't even be a part of that team.
You are, for the most part, correct. Now, if it's like, oh, my third cousin owns shares in blank. So if it's not a direct, so it's not like grandparents, parents, immediate family, you can still be part of an audit team where it's like your sole job is to be like they're counting inventory just to make sure that inventory is accurate. That's okay. Generally, having said that, you would have had to disclose and they're going to look into it. But if it's like, my fiance's dad owns this firm, I'm the partner running this audit. Yeah, that's absolutely out the window. It's not possible.
With Evergrande, PwC, but I still feel like even then, maybe they're paying PwC for a reason instead of KPMG or instead
no. And so, here's the funny thing. So PwC's withdrawn from the engagement.
Okay, yeah. So why do they do that? That's very interesting.
Why
would they do that? Come on, man.
So there's two reasons. Well, there's two, maybe three reasons you withdraw from an engagement. So when an auditing firm or an accounting firm withdraws from an engagement, it's not that they're not willing to write an opinion. It's that they will not write.
And what will motivate them to not write an opinion at all?
So what would cause them to withdraw from an engagement? So what PwC's done?
Totally.
So there's a few things. So it might be something like the firm has told them, we need you to audit our books and they need to be done in 2 weeks. And the audit firm goes in and goes, and initially the audit firm agrees initially the firm agrees and goes, okay, well, actually maybe in 2 weeks we could do that, or in the agreed upon specified period of time, they're like, we could do that. It could be doable.
In that case, it's their bad.
And then as they perform the audit, they realize, actually, no,
need a lot more time than this.
We're dredging up a lot of issues, and so if these things work out, which they're obviously written in the contract, if these things work out, we're going to be delayed, and then they start to get delayed, and then the management or the ownership goes, no, we need your opinion right now, or else. And then the firm goes, and the audit firm goes, fine, or else we withdraw from the engagement. You don't have to pay us for the work we've already done. Granted, no one else gets the work product, so it's it's destroyed. But it's them going, no, we're out. Another reason you might withdraw for an engagement, and specifically, is that the firm you're auditing tells you, we're going to sue you. We're considering legal litigation against you. Suddenly, we're not in a position to be able to be impartial. Yeah. So we're like, okay, well, we're out then. And
I don't know if that's a possible thing though, because I don't know if do you honestly think PwC is being sued by Evergrande?
Absolutely not. No, I think what's happened is what I think has happened, and this is again personally this is just my opinion. I have no evidence to back this up. And so I think what's happened is PwC has told them what they need, what they require, and they probably started some time ago on the audit. The issue is that Evergrande has been laggardly in providing the documents and has been and has been slowing them down at every point, to the point where PwC is going,
they're giving them time crunches and they're saying, okay, where are the results?
Well, where are the prints, where are the printouts? And PwC's like, oh, I'll get it to you tomorrow. It's like, I issue you a pine tomorrow. Also, here's all our data today. They're trying to put them in a time crunch, and PwC is just going, you know what? Nah, we don't want to be your auditor. We're not your auditor anymore. Wow. Now I say a withdrawal from an engagement is often that's considered not
rare.
It's not as rare as you'd think. It's actually more common than a lot of the other accounting audit positions, which an accounting audit firm can give one of essentially four positions. They give 3 positions, but no, it's 4 positions. They give an unqualified audit, which is to say your books are absolutely perfect. Nothing we found is out of the way. They give a qualified position, which is to say your books are solid except for these 2 or 3 specific things that we look at and we go, these things seem wrong. Yeah, they can disclaim a position, which is to say these are their books. Yeah. We have no opinion on them. We have not successfully audited them at all. We have not done anywhere near enough work to tell you whether or not they're fine. Yeah. And then there's an adverse opinion.
These are not accounted for.
This guy said 2 + 2 = 17. And let me tell you about how that doesn't work. So that's an adverse opinion. So usually what you see is a firm that withdraws from an engagement. It's a lot easier than if they are the firm that disclaims an opinion. So with PricewaterhouseCoopers and Evergrande, my opinion is they refused the engagement. They quit the engagement.
They saw something massively wrong, and they're like, "I don't want to report this on Evergrande because they could sue me." Or
no, not because they could sue me. They can't sue me if it's true. Right. What they said is, the base model of our business is not based on giving adverse opinions, and the best we can do for you, is to disclaim an opinion. The best thing we can do for you is to put your books out there into the world and say,
or
we can withdraw now and not have anything to do with it. And on top of that,
we didn't know that. We didn't see that. We didn't have access to those files.
Well, no. Even if they didn't say, they said, what you want us to do, we can't do.
Fair enough.
Won't do. Yeah. Whatever it is, we're out. And it gets worse
because they're paying paying you for a service.
Because they are paying you for service. That's the one thing, and that's the one big thing that I look at with the auditing firms. You're being paid for service, so you are kind of beholden to the client, but your duty is to the potential investor, not to the guy that's paying you, and that's why maybe a lot of these big firms should pay into a fund, just a group fund run by the SEC or whatever.
But that's tough because I feel like any accounting firm, in order for them to actually make money, what do they need is clients, right? So they need.
But the thing is, they should get paid. I think they should pay from a third party pool paid for by the people they're auditing, but not by the people they're auditing. But at the same time, it's really hard to also provide the other accounting services that the firms provide. Without being at the point where it's like, well, I can't audit for you and be your consultant. Yeah, but if I know that I'm your auditor, I just don't consult. Yeah,
but the thing is, if you're JP Morgan Chase and you hire KPMG to do your books, or if you're Goldman Sachs and you hire KPMG to do your books, whatever it is, or whatever.
Sure.
You're hiring them because you're saying, we know that you can make us square with the IRS.
No.
So if there's an issue with the SEC.
That's not what they're saying at all.
Okay,
when
fine.
I hire an auditor to audit my books, what I'm saying is I stand behind my books 100%. I'm bringing in external an external auditor to come in and look at my books and to tell the world, to opine.
Why do you need to tell the world?
Accounting.
Why do you need to tell the world that your books are clear and transparent?
There's
2 reasons. One, it's because
I want more people to invest.
Okay, so there you go. So there's a fiduciary responsibility, and then 2, you want to make sure that you don't get pinched by the IRS or the SEC.
No,
is that fair?
No, the only one is I want my investors to feel safe investing with me.
Isn't it the same thing?
The SEC and the IRS have nothing to do with my audit.
Why not?
All my other business practices must be on par with the SEC and the IRS. My taxes should have nothing to do with my audit, which is really weird to say. But I feel like I only pay taxes on my gains, on my profits.
I know, but that's what I'm saying is like I feel like you hire an auditor to say these expenses were legit.
No, because the IRS's job is to tell me my expenses were not legit.
But how would they know? How would the IRS know if your expenses were not legit?
They investigate what I spent my money on and where I spent my money at. Yeah.
Okay, so what do they do?
If I spent $6 million at a titty bar and I'm a restaurant,
T&E, man.
Did you just say T&A? T&E.
That's what I said. I understand you're upset about the dinner, but I did say T&E.
Sides did cure cancer.
What are these sides that cure cancer? Yeah, that's the problem. Sides that do cure.
They did cure cancers.
Yeah.
But no, so
the IRS has nothing to do with an audit. So if you did an internal
absolutely
audit,
not.
Wow, I really thought for a second there you did the audit because you.
So here's the beautiful thing. So this is the beautiful thing about an audit. The entire premise of an audit. So you know how it's
so the audits could really. So in this case, but the way I'm looking at it now
audits
is like
often said that Enron was fine.
So they really sweetheart your books.
No,
I know they don't. I know they don't. But what I'm saying is in the sense that they provide that extra confidence. So like if Arthur Andersen said these books are fine, there's nothing to worry about here. It makes all the investors into that company say, Arthur Andersen's a Power 5. Like, of course we're
Arthur Andersen. I trust Arthur Andersen.
Of course we're going to agree with their conclusion. So
why not? Enron's making good money. Look at that stock price. Absolutely. No. So the entire the purpose of the auditor.
So I'm an idiot.
The sole job of an audit is to provide you, the investor, with an assurance. So assurance that the books the business is sending you are an accurate representation of their business.
So but my thing is, when you look at their books, if you're an investor, you have access to their K1. And where do you follow their K1? Or where do companies follow their K1? What entity did they follow through? The SEC.
Yes, but the SEC doesn't have the time to go and audit all of the businesses, but the accounting firms, the public accounting firms, go and audit the firms.
Yeah, so I guess it's fair
because they're legally required to have an audit every year. Even big private businesses that are all in securities business are required to be audited. Yeah,
if the
auditors come in, they look at it and they go and they give an opinion and they say, based on our audit and a degree of statistical significance, because obviously that specific phrase out there.
Well, yeah, because the statistical significance is like, is this a big enough faction that actually is going to make someone make a decision to not buy in, right?
Well, the funny thing is I actually really enjoyed this one. Is 4 dead men a big deal? Well, if there are 4 conscripts in Ukraine, no. But if it's 4 major generals in Ukraine, yes.
That's a big deal.
And to be fair, the Russians have lost more than 4 conscripts, and they have lost more than 4 major generals. And so it's one of the things you're like, well, it all depends on what we're talking about.
So the thing is, like, I honestly thought that audits were actually one of those things that companies did as a risk compliance thing.
Well, it is.
I know. In a sense, it is like a risk to the shareholders. But and so here I am. This is an eye-opening thing for me. Okay, so it's not one of those things where
it's not a rubber stamp.
But I thought it was one of those things that they did because they're like, okay, I want to be in the good with the IRS. Make sure that I'm in the good with the IRS, because when you hire a tax accountant, it's like, all right, make sure that I pay the littlest amount of tax that I have to pay without any sort of other additional repercussions now or down the road.
What happens all the time?
That's what they did.
Well, yeah,
but apparently I'm wrong because it's
legally in the United States, your auditor is not allowed to provide that service to you.
Okay, so there you go. That's something I didn't know, and
your auditor can only do 2 things. He can audit your books and file your taxes.
Okay,
anything other than that, he is not legally allowed to do. They are not legally allowed to do for you.
And I'll 100% drink to that. That's fair enough.
Oh, yeah.
I just didn't know that about auditors. But anyways, I want to talk about credit spreads because the biggest credit spread right now is the 3 and the 10, not to mention the 5 and the 10, and the 7 and the 10.
3, 5, 7, and 10?
The 3 and 10, 5 and 10, and the 7 and the 10 have all inverted, which, if you think about it, that makes no sense, right? So you're probably conceptualizing that in your brain. Makes no sense. I get it.
Well, I would say it's a better bet to buy the 3-year than the 10-year at this point.
It sounds like backwardation, like for futures. That's exactly what it sounds like. So very much inverted yield curve, which I don't know why, but this makes me want to talk about credit spreads.
Sure.
And we're not talking about options credit spreads.
No, because that's the fucking Wild West.
No, yeah, that's essentially like a one-sided, like a half of an iron condor is what a credit spread is for options. But I don't want to get into that.
No, neither do I.
Credit spreads for bonds,
which is really what we talk about. So when we talk about credit spreads, we talk about bond yield spreads essentially. And it's that weird comparison of whatever corporate script or corporate paper you're talking about.
So like a JP Morgan bond or an Apple bond or a Google bond
versus whatever the equivalent treasury is that matures at the same time, right?
So if JP Morgan issues a 10-year bond, a 10-year debt from you, right? So you can buy JP Morgan bonds on the secondary market. They're not hard or whatever.
They're out there.
Any sort of giant company, you can buy their 10-year bonds.
Just like any United States government, you can buy any one of its bonds.
Yeah. Obviously, it's probably better that you understand how bonds are quoted and all that kind of stuff before you do that. But you can buy those bonds on the secondary market. But if you don't like your grandkids, who cares? Just buy them and just, give them their yield, right? But if the 10-year U.S. bond yield is, what is it now? 2 and 2.3%.
It's 2.3, 2.4.
It crossed above 2.4 for a bit today, right? Which the nice thing to see nowadays is like the 10-year yield and the NASDAQ kind of have the relationship is more
death grip.
No, not the death cross. No.
I said a death grip. They've got each other by the fucking collar, and they're like, dear life.
It used to be like an inverse relationship, but now they're kind of moving in unison, right? Like as the 10-year goes up, the NASDAQ goes up, which is weird. Like it's so weird to see that now, because for 2 years I was used to seeing an inverse relationship.
I wasn't expecting the NASDAQ to do what it's doing, but
whatever. But
I don't say I'll take it, but I mean, there are worse things.
There are much worse things, but credit spreads, that's basically like, okay, so if JP Morgan issues a 10-year yield, a 10-year bond, and the yield is 4% and the US 10-year yield is 2.3%, the credit spread in that situation would be 1.7.
It's 1.7.
Right.
Yeah. So the difference is between whatever security you're talking about and then the risk-free US Treasury that matures at the same time, right? So
exactly.
You have to compare two apples from different orchards. Yes, is the way to put it.
So it's not options. The options credit spreads are like, if you sell a call
also drink for two apples from different orchards.
Okay, fine. I'll drink because Irish whiskey tastes like apples anyways.
Well, also you.
Okay,
exactly.
I'm following your orders. Okay,
listeners,
Irish whiskey tastes like apples. Yeah.
If you have to drink what I do in an analogy, done.
Or if I stutter, if you have to drink when I stutter, you're not making it home. Sorry.
Well, if you drink when I stutter, good knowing you. It gets worse.
Anyways, so the reason why credit spreads, I guess, are important is because a lot of people look to the 10-year as the risk-free rate.
It's a good benchmark, yeah.
Absolutely. And if you know anything about risk premiums or portfolio management, a lot of risk premium just basically means your return on investment minus the risk-free rate. And the risk-free rate is basically your guaranteed return on investment. And your guaranteed return on investment, according to most portfolio managers, is whatever the yield on the 10% bond is.
Well, 10% bond, again, we call it the risk-free.
I don't know, but that's a lot of people use that as the risk-free benchmark. Some portfolio managers like to use a nearer term treasury, whatever, but a lot of portfolio managers like to use the 10-year for some reason. And if for some reason a company like JP Morgan or a company like Bank of America, a company that doesn't really default on their loans, if they suddenly offer a 10-year corporate bond that is like 4% higher yielding than the US 10-year, a lot of portfolio managers might seek that instead of the US 10-year. But if all of a sudden all these giant companies are saying, all right, with the 10-year yield being at 2.3%, we're going to start issuing 10-year bonds that yield 2.5%. It's kind of like a decrease in sentiment.
Absolutely. Yeah, no, it's
yeah.
So as I understand it, when you start to see credit sentiments shrink, what you're seeing is that either the risk-free rate of the government bonds is increasing, or the price is shrinking. So it's the rates are coming closer together. So the spread is decreasing.
But normally it's because like the banks and the giant corporate bonds, like they're a little bit behind the 10-year yield. Yeah. Normally they are.
Well, the 10-year yield is essentially when we're looking at.
I don't know why they are, but.
Well, it's because they're issuing now, and the 10-year yield it's slowed down, kind of like because like the Supreme Court, it's behind on times. It's deliberately watching something that happened 9.5 years ago at the earliest, or 10.5 years ago at the latest.
But I guess essentially, like what it comes down to is the fact that these credit spreads are tightening. Basically, what it comes down to is like you can either take on a ton of risk and buy a corporate bond, or you can take on no risk whatsoever because technically it's a risk-free rate. Obviously, every investment comes with risk.
Treasuries.
Right.
Now, having said the U.S. Treasuries come with risk, and that's absolutely true, they do.
They all do.
If there is an actual risk that the United States Treasury will default on its bonds,
that would be a terrible day.
It would be a terrible day. And I'll be honest, whatever you thought, you don't only go with treasuries, you have other things too. And let me tell you, you started panicking 6 months ago when everything else started to go wrong.
Right.
Because the treasury would be the last thing to fail.
Well,
and if they do, you have bigger problems.
Yeah, because like the yield in the bond could decrease or increase, whatever it is, right? There's the yield, and then on top of that, there's the actual price of the bond. There's the principal.
Exactly.
So if the principal,
the actual bond,
it's not risk. Yeah, it's not risk free, but if you wait until maturity, it probably technically is risk free.
Well, it is. It is with the U.S. Treasury because the United States Treasury is still here, and we're one of I think 12 countries that have never defaulted on our debt.
Yeah, but
never.
Does anybody want to buy a JP Morgan bond now? Does anybody want to lend money to a corporation now when you can just lend money to the federal government and it's pretty much backed by the good faith,
full faith and credit of the tax-paying citizens.
Yeah, exactly. I mean, why would you buy one?
Yeah,
I'd much rather
if they're offering me enough money.
Yeah, for the risk, like if the risk premium is that low, like why would I ever go? Why would I dip into that?
Yeah.
So that's my thing. I think that's a big thing for people that want to know anything about portfolio management and asset allocation is. All right, credit spreads are tightening, not from the options perspective, but from the bonds perspective. Like it's that.
Yeah. It's at least the last 10 years.
Yeah, there's been an inversion between the 3 and the 10, the 5 and the 10, and the 7 and the 10.
And the 7 and the 10, yeah.
Yeah, it's not bad. And I think at one point there was an inversion between the 2 and the 10, but I don't know.
Well, give us a week.
Yeah, give us a week. We'll see. Bond markets are reacting crazily to the Federal Reserve.
Well,
it seems like nobody's confident in the short term, which is the reason why there's this inversion. And if you know anything about the inverted yield curves generally mean people think that there's
more money in the long and the short.
Yeah, exactly. So people are not confident in the economy.
In the short term, they're more confident. In the long term, they put money into a long-term ability to repay versus a short-term ability to cash out. Yeah. And that's where you start to see this it's basically in ancient Rome, Crassus used to sell fire insurance. And what he really meant by that was if your building was on fire, he would show up with his own fire brigade. And he would say, I'll buy your...
Do you want fire insurance?
No, he'll say, I'll buy your building for blank. And if you said no, your building burnt down.
All the way down.
And
if you said yes,
the fire got put out and you got to keep your things and you could rent from him. It was a horrifying way to do business, but it was a thing.
Yeah.
It's literally where the expression of fire sale comes from. It's the building's on fire. Anything inside it is for sale at liquidation
the best
prices.
time to sell against tornado insurance, or the best time is to sell against earthquake insurance, or whatever it is when the house next door got destroyed by a tornado or an earthquake. Because psychologically,
you're willing to buy.
The next door neighbor is like, yeah, I don't want that to happen to me. And if that does happen to me, I want to make sure all my stuff is safe. So
I want to make sure I'm fully insured.
Yeah. So that to me is a very good business decision. Just like if you went to my spreadshop.drunkenomics.com, that is a very good business decision.
Aaron, have you seen the hoodies?
Because the hoodies are great. They have black hoodies. They have darker black hoodies.
We got some pretty sweet navy blues, some nice blue gray, some blues.
Some reds if you like to watch the Huskers, the Nebraska
If you
Huskers
like to go big red.
If you like to go,
Look,
I like
all
to go
I'm gonna
big
say
red.
is, if you get a color you like, you can Drunkenomics that in a hoodie.
Tag us in your posts. I mean, seriously.
Absolutely, you always should. I
actual
appreciate that.
posts, always tag us. We appreciate them all. And
But it's so beautiful.
absolutely.
No, I'm
It
gonna.
really is. It's gorgeous. It's beautiful.
I think we
Yeah.
should. I think we should say Sylvie is turning 16. So Kim and Chad Sylvie is turning 16 this Saturday. I
Happy
think
birthday,
we should
Sylvie.
shout out
Let's do
Sylvie.
it.
Happy birthday,
Happy
Sylvie.
Thanks for. Hopefully you're listening. If not,
it's
it's probably better for you.
better
but-
for your health, maybe. But
You're only
well,
16.
I'll say this.
Yeah.
Happy birthday. Stay drunkenomical.
Please.
And
we have a Patreon. We if you want to help us keep the
lights on, the ice frozen,
Which we
and
call
Aaron in a gym that isn't Jim Beam. We've
And-
got to get some money behind us because
Yeah,
look, Aaron's
is
a
it-
beautiful specimen of a human, and I'm not gonna lie.
Well, I don't know about that.
Aaron's the
but
D1
I don't know
athlete
about
out of
that,
this, and
but-
I'm still 2 inches
I-
taller, and I don't know how that works.
So golf is that
Hey, you're a
sport?
D1
I don't know.
athlete, and
well,
I'm a D3 reprobate. So
I guess
that's
I
all
could
I
say
know.
that.
It's all I know out of UCF rugby. And it gets worse.
Either way, I forgive you. Rugby is
It's a game we
Rugby's
play.
actually
Be
for
fair,
athletes.
What I
Golf
like to
is
say,
not.
I'd like to see
but-
golfers and rugby players drink together and discuss economics. Oh shit, we
I
did
would
it
too.
We did it
Oh my God, it's
first.
happening right now. That's
Welcome
literally
to
happening.
Drunkenomics.
Welcome to Drunkenomics, and all I have to say to you, I know this is a weird sign out, but all I have to say to you is continue to play chess, not checkers. Always, don't brag, just say, fill and kill. What else do we have to say aside from those?
Well,
three?
clearly,
I forget. Come on.
Stay drunkenomical, folks. And
That is it. Cheers.
Cheers.